introduce all of you to Alexandra Readhead. She is flown in from Oxford, where she's based currently, and does a lot of consulting work for countries and tax administrations around the world in the area of tax avoidance as it relates to the mining industry, the extractive sector as it relates to mining. And she has published a number of reports on how developing countries and tax administrators can be much more effective in asking the right questions of mining companies as it relates to the tax avoidance strategies that they have implemented, and how developing countries as a result can harness more or mobilize more resources for development. So some of the work that Alexandra has done for the IGF, the Intergovernmental Forum for in the mining and metal sector, some of her experience in advising tax administrations, testimony she has given before parliamentary committees and so forth, gives her a tremendous wealth of experience to share some raw stories in terms of what has worked and not worked in this area, and how developing countries can be much more focused in getting what is the fair share from the mining that is taking place in their countries. So with that, let me turn it over to Alexandra, and then she will give a presentation for around 45-50 minutes, and then we'll open it up for questions. Okay, thank you.
Hi everyone, nice to meet you all. As Christian said, my name is Alexandra, and I'm from Australia originally, but I live in the UK currently. I'm a lawyer by background, and my work currently focuses on advising governments, specifically tax authorities, on how to more effectively collect revenues from the mining, oil and gas sector. So I'm going to stand up because I need to use the keyboard to click through. This is what I plan to do in the 45 minutes that we have together today before we have more of a discussion. So firstly, just briefly outline the importance of the resource sector for many developing countries in particular, which I'm sure many of you are familiar with that, so I won't dwell on that for too long. The risks that this presents with respect to corporate tax avoidance in mining and oil and gas, challenges that developing country governments experience when it comes to trying to implement the arm's length principle, dealing with cross-border transactions in the extractive industries. Then turning to what are the alternatives. So the alternatives with respect to dealing with cross-border trade, formulary apportionment, destination-based cash flow taxes, and explain to you why I think neither of those proposals are particularly well suited to the extractive industries, and so as a result why we need an alternative to the alternatives, if you like, which is my proposal, which is essentially to look along the mining, oil and gas value chain. What are the areas of risk with respect to cross-border trade and transfer pricing specifically, and as a result, what kind of targeted incremental tax policy solutions should we be considering to try and reduce opportunities for tax avoidance in the sector. And to do that, I'm going to share with you some experiences that I've been involved in these countries that you can see here on the screen, which are devising and implementing kind of alternative tax policy rules in the extractive industry specifically. So I think part of our role, yes?
Could you just give us a little background? More, he gave kind of a very quick introduction. We want to know who you are, sort of where you've been, all the time you spent in Sierra Leone.
Yeah, okay,
some of the local culture, just forward.
Fair enough. So who am I? Well, as Jim mentioned, so before a couple of years ago, I was living in West Africa, in Sierra Leone specifically, for 4 years, where I was working in the President's office on mining contract negotiations. So, as I said, lawyer by background, and was working to help the government of Sierra Leone negotiate better deals with mining investors, which didn't necessarily go that well, obviously through no fault of my own, but rather political interference. So Sierra Leone is a challenging country to operate in because it's intensely political, and there are significant issues with respect to corruption. My boss, who was the chief of staff at the time, was unceremoniously dismissed and sent to jail for corruption in the mining sector, which was an interesting experience for me to kind of see what politics looks like up close and personal, how that relates in terms of decision making, how we need to bear that in mind with respect to the kind of proposals that we put forward to try and change the tax system. Part of the reason that I come to be doing the work I am now is because, again, when I was living in Sierra Leone, I started to witness tax avoidance in the extractive industries, in particular one company that was selling its iron ore to its major shareholder in China at a very low rate, significantly below the market price for iron ore. And we, at the Ministry of Finance, with my support and others, launched an investigation into the pricing arrangements with respect to this company and its related party offshore, which is still years later kind of a work in progress for the government of Sierra Leone. But it's interesting because you witness the trade-offs that governments have to make in terms of needing to attract investment. Sierra Leone is a very poor country. It was at the bottom of the Human Development Index not long ago. It was the worst place in the world to be a mother. 1 in 8 women died during childbirth. So obviously the need for revenue is really acute, which means that you need to get investors into the country, which may also mean that you then feel the need to offer a range of incentives to attract those companies, particularly because you don't have a lot to offer. Your road network is very poor, you don't have reliable power anywhere in the country outside of the capital city. Your human resources are also, there are limitations with respect to their expertise as well. So I think these are some of the, I guess, the background that I have that I bring to the work that I do now, which hopefully makes it relatively practical and trying to account for some of those factors. So the work, my main work these days is with a group called the Intergovernmental Forum on Mining, which is the global body representing governments of mining countries. So it has 60 member countries, which there's a big spread from developed to developing. And we're working together with the OECD on how to come up with kind of tax solutions for the extractive industries in developing countries. So what might be specific rules that we could put in place to deal with the pricing of mineral exports, as well as all the costs and services that companies need to operate, which they might bring in again from related parties offshore. So that's the work that I'm doing now. So I hope that's given a little bit of colour. I mean, there's certainly quite a lot of it in Sierra Leone, that's for sure. So that's what I wanted to do, if that's okay, in the time that we have together. So with respect to the first point, which is really why is this important? Why do I care about the extractive industries? I'm not deeply wedded to mining and oil and gas, but I see that it's an important opportunity for many developing countries to kind of get on the ladder of development, if you like, to then be able to use those resources to invest in other sectors of their economy to try and diversify away from the extractive industries. So as you can see up here from the IMF, this is the extractive industry revenues as a percentage of total government revenue. So it's enormous, particularly in oil and gas, because you're dealing with huge revenue streams. But for many of the countries along here, developing countries, so you can see Sierra Leone here, that's just shy of 20% of total government revenue comes from the extractive industries, which means that it's absolutely central to these countries' economy. And also, many of these countries might have very limited investors outside of the extractive industries. So it's not like they're dealing with investors in multiple sectors, but rather they have minerals. So they have 4 or 5 big multinational mining companies that have come in and decided to invest, which means that they are really at the centre of all of this. So extractive industry revenues are absolutely critical for developing countries, which means that in turn this presents a big risk with respect to tax avoidance. So if all your eggs are in one basket, then obviously you're somewhat exposed in that regard. So what you've got up here is just a network graph that we did a while ago in my work that shows you the tax havens and non-tax havens. And it's not particularly clear, but you can see here, these are some of the largest mining companies on the FTSE 100 and the countries in which they have 20 or more subsidiaries. So the red countries are tax havens. So you can see, for example, Rio Tinto here has, it's too close, I can't see it, but multiple subsidiaries, for example, in Singapore and Luxembourg. So this isn't necessarily evidence of tax avoidance, but it does demonstrate that there's a significant risk with respect to cross-border trade in the extractive industries. So Why focus on the extractive industries? Well, they're very important in developing countries, a major source of government revenue, which means that any tax avoidance in that sector is going to have an outsized impact on the country's share government budget. And I think as well now in a low price environment, so we've had kind of a fall in commodity prices, both in hard minerals and in oil and gas. It's even more important to focus on tax administration and trying to reduce opportunities for companies to engage in avoidance, because there is pressure on government budgets because of those low prices. So we need to focus on making sure that the existing mining, oil and gas projects actually contribute their fair share towards government budgets. It's also an opportunity to try and introduce good practices on the part of governments, because when prices are very high, often governments are less concerned about whether or not their tax rules are robust to avoidance and other issues, because they're still generating a lot of revenue from the sector. But with prices being lower now, and so revenues being lower, there's an opportunity to work with governments to make sure that we have strong rules in place, good implementation in place, so that governments are in a better position to collect the rents from their natural resources when prices rise again. So I think there's kind of a sweet spot right now, if you like, to be working on things like transfer pricing and tax avoidance in this sector, because there's a lot of attention and interest from governments to try and get it right, so that then when prices pick up, they make sure that they actually get their fair share of the return. So we know that resources are important in developing countries. We know that as a result, they're quite exposed to cross-border trade and opportunities around transfer pricing. So what's happened as a result? You're all very familiar with the OECD BEPS project that's been going on to try and tweak international tax architecture to make abusive transfer pricing more difficult to achieve. At the regional level, the African Tax Administration Forum, which is a group that I work with quite a lot, which has 34 member countries, they've also developed their own model transfer pricing legislation, which is something that they're promoting amongst their member countries. So there's a lot of activity underway, and what you see here on the screen is some research done by Ernst & Young, which just shows the increase in transfer pricing legislation in African countries since the mid-90s. So it's increased by 600%. And there's a huge amount of focus on this from tax administrations on the African continent, setting up international tax units or transfer pricing teams specifically to work on these issues. I think potentially that is needs to be moderated to some degree, in that a lot of resources are being put into international tax and transfer pricing, which perhaps detracts from the abilities of tax administrations to also collect domestic taxes and to focus on other important sources of revenue. But nevertheless, it's because governments recognise that this is a massive threat to their tax base, and so they're trying to respond by putting in place at least a legal framework to try and deal with the problem. However, again, as many of you are familiar with, I think developing countries lack a lot of the basics or the conditions required for effective implementation of transfer pricing rules. So the research that I did in 2015, which was across 5 countries in Africa, so I spent about 4 months travelling between Ghana, Guinea, Sierra Leone, Tanzania and Zambia, trying to understand what were the challenges that governments were facing when trying to implement transfer pricing rules in the mining sector in particular. And these were some of the challenges that came through that I documented in my work. So despite the massive growth in transfer pricing rules across the African continent, there are still a number of countries where they've perhaps got the arm's length principle in the income tax law, but they haven't followed up with regulations that explain how that principle should be applied, what documentation taxpayers are required to keep, and so forth. So that is an issue in terms of actually being able to implement the arm's length principle. Comparable data is a massive stumbling block for developing countries, in particular in the mining sector, because it's also very uncommon to see independent mining, oil and gas companies. So most of the extractive industry companies are integrated companies. So the idea that you would actually be able to find comparable data between similar independent entities, I think, is kind of in question with the extractive industries especially. So that's an issue. I think oftentimes consistency between mining legislation, transfer pricing rules. So the mining sector is one where you often have layers of legislation. So you'll have obviously the Income Tax Act, which might have a specific schedule for the mining industry with specific tax rates and so forth that apply to that sector. Then you're going to have the mining code itself, which then is going to set out additional fiscal terms for the sector. And then you've got contracts. So you've got project-specific contracts that are signed, which again introduce another layer of complexity, which are specific fiscal terms for mining projects on a project-by-project basis, which can be very difficult from an administrator's point of view to try and deal with the different levels of rules that might apply to a company. And for example, in Ghana, they introduced transfer pricing rules. However, the petroleum sector is subject to its own petroleum income tax law. Now, in the petroleum income tax law, they hadn't made any reference to the transfer pricing rules that sit in the income tax code. So then when the government tried to apply the transfer pricing rules in the income tax code to the oil and gas companies, they threw their hands up and said, well, that doesn't apply to us because it doesn't feature in our petroleum income tax law, which governs our sector. So this is an issue in the extractive industries where you might see kind of conflicting rules across the sector or gaps that need to be addressed. The coordination challenge, I think, how is this unique in the extractive industries? Because in the extractive industries, you're going to have a number of government agencies that are responsible for collecting different types of information around the sector. So you've got the mining ministry that's going to be collecting information on production, so how much is the mine producing, what is the value of their exports and so forth. You're going to have the tax authority collecting tax returns, financial information. You might have the central bank playing a role. If you're dealing with gold and diamonds, they have a role to play there. And so the responsibilities for information collection are often very diffuse across government, which means that unless you have effective systems for exchange of information and expertise actually within governments, there can be problems. So you see tax authorities that don't understand the industry very well, and so as a result they kind of dive into particular issues that they might think are problematic, but turn out not to be how they understood the industry in the first place. So often this information and expertise sits in silos across government, which can be problematic in terms of identifying and then actually evaluating transfer pricing risks. Transfer pricing expertise, which I think is the same across sectors, dealing with different sectors. We know that that's lacking in many developing countries. You've got very small groups. In Australia, you might have seen recently, we've been cracking down on Chevron in relation to its intercompany debt arrangement with its affiliate in Delaware. That court case cost us $10 million in legal fees. The Australian government won it, but it's $10 million in legal fees. The Australian Tax Office has an annual budget of about $2.5 billion. It has about 1,000 people that work on intelligence gathering with respect to corporate tax avoidance. You can contrast with that with the tax office in Sierra Leone, the country where I used to work, and you've got 6 people working on tax audits in the extractive industries. Their budget for the whole tax office is about 10% of the Australian government's annual budget. So you're just dealing with kind of vastly different resources in developing countries, which means that ultimately governments are trying to avoid getting into unwinnable battles with multinational corporations. Access to information and political accountability. I think the political question is an important one because I've seen many countries where you've got very capable tax officials who actually have a lot of expertise and knowledge. They can tell you, they bring out kind of a file that goes through all the transfer pricing issues that they've identified with respect to multinational companies operating in their jurisdiction, but they don't feel empowered to actually enforce the law or to commence an audit into these taxpayers. And I think that's particularly acute in the extractive industries because of the outsized importance of mining oil and gas companies in many of these contexts. And the fact that because you have these layers of terms and the emphasis on contracts, which are often signed between the president and the investor, that in some cases the tax authority won't even have access to the contract, which sets out the specific fiscal terms of that project. So, I said earlier in the introduction, I worked in the President's office on mining negotiations, and that says it all. Why should the mining negotiations team be situated in the President's office? Well, it's because obviously they want to have control over what's taking place. So I think political accountability for enforcement is a very important thing to keep in mind. It's the thing that perhaps is most difficult to change and to influence, so I tend to focus more on upskilling of tax authorities and making sure that the legal framework is robust, because I think those things we can control. They make corruption and political interference perhaps more costly, but you know, it's still the elephant in the room in many of these situations. So those are the challenges to implementation. They are enormous. And generally well documented in the literature, the problems that developing countries face with respect to the arm's length principle. So what are the alternatives, and are they fit for purpose for the extractive industry specifically? Well, the first one, as you're aware, is formula reapportionment. And I think it's important to be upfront about my reservations with formula reapportionment. I have technical concerns with respect to how it would apply to the extractive industries, but I think I'm also a little bit pessimistic about the political prospects of this alternative. And I think that now we've just gone through the OECD BEPS process, and we've seen that the power that OECD countries continue to have with respect to influencing international tax architecture is not going anywhere. They come up with all these new standards now, and then they're seeking to bind developing countries to those standards through the inclusive framework, which many developing countries are willingly signing up to, but that's largely because they would prefer to be at the table rather than on the menu, I think, which is why they are wanting to participate in that inclusive framework. But I think with those kind of politics in mind, I don't have much hope for formulary apportionment as an alternative. Why it won't work, in my opinion, for the extractive industries is because if we assume that the sales-based factor for formulary apportionment is the factor that is used to allocate profits, which I think is likely given the politics of international decision making, that for many developed countries the sales-based factor is going to be to their advantage because they consume more than many developing countries. So if we assume that the sales-based factor is the one that's used to allocate profits, then what that's going to do is it's going to mean that there's an under-allocation of profits in the countries where the resources are extracted, right? Because all of the iron ore or the gold comes out of the ground in Ghana or Sierra Leone, it gets put on a ship, it gets sent to China or wherever the customer is, and then as a result, the multinational entity would be paying tax in the location where the resource ends up, where it is consumed, as opposed to where it originates from, which obviously wouldn't be fair. There are some academics that have suggested including an extraction factor as part of the allocation formula for formula reapportionment, which would be, for example, they do this in Alaska, where they say it, depending on the number of barrels of oil, that is then used as a factor to adjust the allocation of profits. So there was a court case between the government of Alaska and an oil and gas company called Tesoro Corporation with regards to the government trying to attribute about $200 million in profits back to Alaska from, I think they were selling their crude oil offshore to an entity in another jurisdiction, which was then on-selling it, which is common in the extractive industries. And so they were trying to reattribute that profit back to Alaska. There was a lot of litigation. Ultimately, the government of Alaska was successful, but I think generally, I think that developing countries in particular are unlikely to strike out on that course without the protection of some kind of global consensus, because what they feel is pressure to offer incentives to attract investment in the first place. And so the idea that they would embark on a fairly unitary course of action, I think, is unlikely. So that's the constraints with formula reapportionment. I think with respect to the destination-based cash flow tax, there the issue is probably even more pronounced, which is, it says it in the name, this is about a destination-based cash flow tax. which again would mean under-allocation of profits in the resource country. And in this, the authors themselves acknowledge that the destination-based cash flow tax wouldn't be appropriate for the extractive industries, and you would have to continue to use some kind of origin-based, source-based taxation for that industry. So I think for those two reasons, which are kind of highlighted here, which is some data from this group, the Resource Earth Data Institute, which show you kind of trade flows, you can see here that Sub-Saharan Africa imports about $4.8 billion of metals and minerals from China. It exports about $15.6 billion in metals and minerals to China. So if you applied either formulary apportionment or destination-based cash flow tax without significant kind of modifications, you'd see all of the profits being taxed in China and very little accruing here in Sub-Saharan Africa. So for these reasons, I think that it's unlikely that those alternative proposals would be appropriate in this industry. And I think even if there is a way to modify them, and perhaps there is, it's going to take considerable time to do that and to achieve any kind of global consensus with respect to these two proposals. And in my view, this is something that developing countries cannot afford, time. They don't have the luxury of time. For many developing countries, they are enormously reliant on corporate income tax as a major share of government receipts. So you can see here the data from UNCTAD. For African countries, 30% of their tax revenue comes from corporations, which means that they are very vulnerable to corporate tax avoidance because they rely on this as a very important source of revenue. And I think that this is even more pronounced in the extractive sector. So the extractive sector is one in which multinational companies dominate. So in most cases, you're dealing with integrated mining companies or oil and gas companies that take the resource out of the ground, they sell it in a raw, unfinished form to intermediaries with related parties offshore, who then on-sell it to independent customers elsewhere. And then similarly on the import side, all of the costs, the machinery, the procurement that's being done, the financing and so forth, all those services, management services, etc., are being provided again by related parties that are part of the same multinational group. So it means that you've got a huge dominance of multinational corporations in this sector, and this data again from the IMF just shows the proportion of natural resource taxes paid by multinational enterprises. It's enormous. So because of these reasons, I think the alternatives that have been put forward are not immediately suitable to the extractive industries. I think if they were to be suitable, they would have to be significantly modified. I think that takes time, and I think this is something developing countries can't afford, particularly in the extractive industries, where not only do multinational entities dominate, but you're dealing with finite resources. So you're dealing with resources that are going to be finished very shortly. So I was saying at lunch to Jim and Christian that I've been doing some work in Cote d'Ivoire over the summer, and they have offered a 5-year tax holiday in their mining tax code. But you're dealing with some gold mines that only have a lifespan of 10 years. So if you've already given away tax revenue for 5 years and the mine itself is going to be operating for 10 years, you have very little left. And this is normal across the sector, that you have maybe a mine is going to be 15 or 20 years in its lifespan. So really you've got a short space of time in which to get this right and to make sure that governments actually collect a reasonable share of the return from their resources so that they can begin to invest in other sectors, diversify away from extractive industries and grow their economy in other directions. So this is why I feel very passionately about the extractive industries in particular, because I feel that for many developing countries, this is really their best shot at moving ahead, is to make sure that they actually collect revenue from this sector so that they can move forward. And you have a window of opportunity in which to achieve that. So my proposal, it's not going to light the world on fire. It's not a kind of big proposal for changing international tax architecture. It's really just about trying to look at the value chain and understand what are the areas of tax risk in the extractive industries, and how do we devise kind of targeted incremental solutions to address some of those areas of risk. Because in my view, the thing that's exciting about the extractive industries is that we actually stand a chance with respect to dealing with tax avoidance relatively comprehensively, I think, because unlike Starbucks, Google, Amazon, etc., where you're dealing with intangibles, intellectual property that can be shuffled around the world wherever the lowest tax rate is, or where you're dealing with brands and so forth that are hard to value. In mining and oil and gas, you have an asset. That asset is in the ground. It's in a fixed location. So that in and of itself is a huge win. We're kind of streets ahead than other sectors. So then I think if you can start to tighten the screws on cost items in the extractive industries, costs that will be incurred with related parties, as well as sales taking place with related parties, then we might be able to start to get to a point where we're kind of plugging the various leaks that exist today. So transfer pricing risks in mining, oil and gas, just to give you a sense of what they are. So this is a value chain in the sector. You start with exploration and you end up with something to sell at the end of the day. That could be a pretty long process getting to that point, but that's how it is for mining and oil and gas. And what are the areas of transfer pricing risk? Well, as I've already explained, both in mining, oil and gas, you're going to have a large proportion of sales to related parties. So in Australia, we've been dealing with BHP and Rio Tinto with respect to them selling their mineral products from Australia to a related party marketing hub that sits in Singapore, which then sells that product into China to independent customers. So the question there is whether the price of that sale between the mine in Australia and the marketing hub in Singapore is an arm's length price, whether that's a reasonable value for the sale of that mineral product. Same in oil and gas. There's the majority of upstream oil where they're kind of extracting, drilling the oil, getting the oil out of the ocean bed, or if it's onshore, they're then selling it to a related refinery where it's going to be refined and then sold on in various kind of petrochemical products. Then you've also got the provision of financing. Again, not dissimilar from other sectors, mining, oil and gas relies disproportionately on financing from parent companies, from related entities. Again, the Chevron example I spoke about earlier was a situation where Chevron Australia borrowed $2.5 billion from its affiliate in Delaware, which had borrowed that from capital markets at a rate of 2%, and then on-lent that $2.5 billion to Chevron Australia at a rate of 9%. So kind of excessive interest deductions taking place there as a way of stripping profit out of Chevron Australia, transferring it to Delaware. And this is the same that we see in developing countries as well. Corporate and support services, management services, etc. But procurement's also a big one where increasingly companies have sought to centralise procurement of mining for drilling rigs and various things that you need to operate a mine, and charging a markup or a fee for service on top of these purchases. So those are, broadly speaking, the kind of transfer pricing risks. I see that they fall into two categories. One is the outputs, the sales that are taking place, and one is the inputs. So what are the services that are required by the mine to operate? In oil and gas, it's interesting in that they're perhaps slightly better protected against abusive transfer pricing than mining. The reason for that is in oil and gas it's common to have a production sharing regime where the government and the company enter into an agreement as to how to share the oil production. So what they agree is that the company can take a certain percentage of the oil production to recover their costs. So they sell that oil and use that money to recover their costs. And then what's left, the profit oil, will be split between government and the contractor. And then government can sell its own share of production, it can use it for domestic consumption, whatever. But the result is that in oil and gas, governments are less reliant on corporate income tax. So the main revenue stream from oil and gas in a production sharing regime is the share of production. The company will pay some income tax on the profit oil that they sell, but it's very small in comparison to what government generates from its share of production. So that's interesting because potentially it means they're less exposed to abusive transfer pricing because corporate income tax is less relevant in oil and gas. Not all governments operate a production sharing regime, but about 2/3 of all oil producing countries do. So that's broadly where the risks lie. So what are the specific responses that I wanted to share with you? So if we're saying that there are two areas of risk, the sales and the inputs, then the question becomes, okay, well, what are the rules that we can put in place to try and deal with those two risk areas? So on the sales side, there are a couple of approaches. The sixth method in Zambia, which I'll explain, norm pricing, and then on the cost side, some initiatives out of South Africa and Indonesia with respect to dealing with costs, services from related entities. And then not just about tax policy, but also about government institutions. So, your tax rules are only as good as your administrative capacity at the end of the day, which is often the stumbling block for many developing countries, is they don't have the expertise, the information available to them to be able to implement their rules, or indeed political influence, wins the day. So I think having strong government institutions and coordination between mining and oil and gas folks and tax folks is very important as well, in terms of trying to make sure that we reduce the risk of abusive transfer pricing in this sector. So some of these approaches, the first one is the sixth method from Zambia. So you might have heard about the sixth method, which is the kind of black sheep of the transfer pricing world, which is Argentina decided that they were very concerned that they're a big exporter of raw commodities. Those commodities were being sold to related entities that were sat offshore in low tax jurisdictions, and they were concerned that they weren't getting full value for those raw commodities. So they said, well, given that many of these commodities are traded into terminal markets, so they're traded on the stock exchange, we can use index prices as a way of trying to stop this problem. So what does that mean? So in this instance, the subsidiary of Mali might be selling gold to its parent company in South Africa. It's setting a related party price of $1,000 per ounce of gold. You bring in the sixth method, which says, okay, you can sell to related parties, but I'm going to calculate your sales revenue based on the relevant index price. So gold is traded on the London Metals Exchange. There is a morning and afternoon gold price on the London Metals Exchange. Therefore, I'm going to calculate sales revenue and tax payable based on that price. And if you make more than the market price in your sale, then great, good for you. You enjoy a tax benefit as a result. If you make less, then that's your problem as well. So this is the sixth method. It's been very popular in Latin American countries. Zambia is the only African country to have adopted this method. Yes.
Why is it called the sixth method?
It's called the sixth method because the OECD has 5 transfer pricing methods, right? So this is kind of the sixth method in that it's not formally endorsed or adopted by the OECD, but came about as an alternative because of the level of analysis required to implement the 5 OECD methods is very significant, and this was seen as a much easier way for countries that are exporting commodities traded on terminal markets to go about this. So Zambia adopted this in 2008. So Zambia is a major exporter of copper, which is a base metal which has a price on the London Metals Exchange. They were very concerned that they weren't getting full share value from their copper that was being sold by their mines in Zambia to related entities offshore. So they decided to adopt this method where you must use the London Metals Exchange price to calculate sales revenue on those different mineral products. So what's the impact of that being? Well, they've had a case go through the tax tribunal there recently with Mopani, which is a mine owned by Glencore, Swiss-based company, where they've made an adjustment with respect to the price of their copper exports prior to when this rule came in 2008, and now since then. So they've had that court case recently. I think often it's hard to pin down the quantitative impact of these sorts of rules, but what is clear is that from an administrative point of view, the Zambian Revenue Authority doesn't have to do any transfer pricing analysis when it comes to sales, because it's very clear the price that they use, they calculate the sales revenue and the tax payable, and that's it. End of story, case closed. So for them, it means that they can allocate other limited audit resources towards other problems. So things like finance expense or marketing fees or other issues that are perhaps more complex and more time intensive. by having locked away this problem, if you like. So it's not an issue for them anymore. They're not concerned about underpricing. And also the mining companies are generally fairly happy with this approach because it gives them some level of certainty with respect to tax treatment rather than having to get into disputes with the tax authority in that regard. What are some of the challenges? Well, the Zambians still allow for some adjustment with respect to value. So it might be that the price of copper on the London Metals Exchange is based on the amount of copper, right? A better example is iron ore. So with iron, it's about the iron content in the rock, in the ore, and so the publicly quoted price might be for ore that is 62% iron content, but actually your mine is exporting ore that is 50% iron content. So you can still use the publicly quoted price, but you have to make some adjustment to account for that difference in quality. So this is also what they do in Zambia, which requires having some level of technical expertise and facilities to be able to value those adjustments, to verify that that's correct, because there is a risk that companies are going to undervalue their exports and say, well, actually this has much less iron or copper or gold in it than what it actually does. So that is still a constraint. Coordination is still a problem. So Zambia is an interesting country where you've got the tax authority that has tried to build up all of this expertise. So it has mining engineers, metallurgists, etc. They've got their own facilities to do testing of mineral exports, as does the Ministry of Mines. And so they consistently come up with competing figures, production and export figures with respect to their mining sector that can create issues. So you kind of got a situation where you've got two little fiefdoms kind of going on, which can be difficult in terms of then kind of making adjustments and offering some certainty to the sector and also to the public because they see these different figures coming out. So this is an issue for them. The other challenge is that it only applies to related party sales. So if you sell your copper to an unrelated party, you're not required to use the London Metals Exchange price. In my view, it's better just to apply the London Metals Exchange price to all sales because it's simpler to administer, and otherwise you might get situations where there's kind of gaming. In the UK, in the oil sector, I will talk just now about norm pricing, which is kind of the pricing approach in the oil sector, which is perhaps which mirrors the, well, let me come back to that. But the last point on the sixth method is just to say this is a great approach for developing countries to use publicly quoted prices. It's going to be a lot simpler. You can avoid complex transfer pricing analysis. The challenge is that it might not be appropriate for all minerals. So you've got lots of different types of minerals that have different quality variation, are at different stages of their transformation from being kind of a metal concentrate to a kind of finished product. Which makes it difficult to then apply. There might not always be a benchmark price or a publicly quoted price for every mineral product. So you can see here, this first column is refined base and precious metals, for which there is generally publicly quoted prices. But then when you get over to this space, which are gemstones, diamonds, industrial, specialised minerals and so forth, there won't be a publicly quoted price. It'll all be either a bidding process with kind of very confidential terms or something similar to that, which means that there isn't a price to go to. So the sixth method cannot work for all minerals, but I think that, again, my interest is how can you make this a little bit easier for developing countries so that they can focus those very limited resources that they have on other issues that are more complex, for which there may not be simple solutions like this. So even though it might not be able to be applied to all minerals, it can at least be applied to some, and for those that it can, it should.
In the case of Zambia's Glencore sales, what fraction of those are actually to, quote, related parties?
I think basically 100%. So this is the problem, is that if you're going to get into the business of trying to verify whether or not a sale has taken place with a related party, again, that's an added level of complexity that I don't think developing countries need. So in the UK, this norm pricing approach is something that comes up in gas, which has been, again, the response of oil-producing countries to this problem of underpricing of related party sales. And in this approach, which has been adopted by Norway and Angola and Indonesia, quite a number, rather than calculating sales revenue and tax based on the actual sale price received, the government sets the price. So this is different to the sixth method, because in the sixth method, they take a publicly quoted price. In this method, the government actually goes away and cooks up a price for every oil field for every day. Why is this useful? Because it puts the ball in the government's court, so rather than waiting to receive the company's interpretation of their results, the government makes that decision. So it makes that decision based on the market price that's out there. So crude oil is a very deep liquid market. There's many sources of public prices for crude oil, so that's helpful. Then they make adjustments for the nature of the field and the quality of the product and so forth. But the government issues the price and then the companies are required to use it. So this is an interesting approach that's been adopted for oil specifically. It certainly could apply to mining. There's no reason that it couldn't. In the UK, so in Norway, for example, it applies to all sales. So irrespective of whether you sell your oil to an unrelated or a related party. In the UK, they decided that it should just apply to related party sales. However, they were having a problem because taxpayers were gaming the system where they were basically watching the price fluctuations in the market to make a decision as to whether to post a sale as a related party sale or an unrelated party sale. So when prices were on the up, they knew that the government's posted price would be lagging behind, in which case they would post the sale as a related party sale, so they would have to pay less tax based on the government's posted price, and then they would enjoy that free revenue, basically, where there was no tax payable, right? So they enjoyed that. And similarly, when the prices were falling, they would do the opposite. So they then wised up to this and changed it. So now companies have, I think, 48 hours in which to state whether or not it's a related party sale or otherwise. But these are the sorts of issues that happen when you have different tax treatment, depending on the nature of the sale. So this is the norm pricing approach. As I said, a number of countries have adopted it. Angola is one of them. So they have a group that comes together from the Ministries of Petroleum and Finance. They set the price. It's much easier than having to verify the price of every single sale that takes place. It's still not without challenges. It requires some level of expertise, understanding of oil markets and so forth to be able to set a reasonable price. In Norway, interestingly, they have the Petroleum Price Board, which is comprised of independent experts as well. And they feel that that's important to be able to put some distance sort of between government and the price board that comes up with the prices, because it's an issue of credibility, whether or not the industry feels that they're kind of being taken for a ride and the government's trying to grab additional revenue, or whether the government is actually genuinely trying to engage in a process of setting an approximation of the arm's length price. So I think that's something that's quite interesting for developing countries to think about, where often trustworthiness, integrity of institutions, credibility of institutions is often not a certainty. So it's important to think about, if you are going to embark on these kind of simplification measures, how do you do that in a way that inspires confidence amongst the industry rather than fear and investors kind of scatter and go elsewhere.
Sorry, you probably already explained this, but I'm just a little bit confused about how, like, a corporation or whatever can call themselves an unrelated party. Like, why aren't they still a related party? Like, how are they allowed to classify themselves differently?
Right. So I think it's not so much that they were, in that instance, they were genuinely making a decision as to whether or not to sell internally or to sell externally. So it wasn't just we're going to pretend to be unrelated, because as you say, that's not possible. But in the legislation, they gave them such a long period in which to decide how to sell their oil, that they were actually selling some cargoes to unrelated parties to make use of that when prices were rising and so forth. So it wasn't that they were just kind of faking it. But I think oftentimes, developing country governments do struggle sometimes to map out the corporate structures where, again in Zambia, I know there was an issue with one entity that was purchasing, it wasn't Mapani's copper, but another mines copper, and that party was indirectly related. There was numerous steps within the chain, but they were ultimately related entities with the same owner. But this isn't always obvious to tax authorities. It can be very difficult to map these corporate structures, particularly when you're dealing with privately owned companies, which is a growing thing for African countries, is the role of Chinese state-owned enterprises in the mining sector, which is very difficult because there's no information because these companies aren't listed. So trying to figure out who's involved and whether they're related or not is virtually impossible. So I think people often think I'm making it up when I say the tax authorities can't figure out always whether there are related parties involved, because it should be fairly obvious, but I'm not sure that it is, and it does, and often the information isn't available to them. So the norm pricing approach, I think, is an interesting one. It does still involve some expertise. There needs to be a kind of independent process and some degree of credibility around that. But again, seems to be an interesting solution to the underpricing of crude oil sales. To give you an example, again, in Norway, I was speaking with people at the Norwegian tax office last week, trying to understand the impact of norm pricing in Norway. And just as a kind of anecdote, within the Norwegian tax office, there is an oil and gas tax unit. Within that tax unit, there are about a number of employees. There are 0 people in that tax unit that work full-time on monitoring the sale of crude oil, right? There are 6 people that work full-time monitoring the sales of liquefied natural gas. Now, liquefied natural gas in Norway is not subject to norm pricing. It is only the sale of crude oil that is subject to norm pricing. And that shows you just the level of investment in terms of human and financial resources on the part of the tax office to dealing with the sale of liquefied natural gas, LNG, as opposed to crude oil, because there's different tax rules in place. One, the norm price rule, which is much simpler to administer and gives government confidence about the pricing of those transactions that they don't have in relation to LNG. And I think that's been because in future they would like to have a norm price for LNG, but it's a much newer market that doesn't have the same depth to it, the same availability of benchmark prices as crude oil does. So that's an example. Also, the number of disputes. So they're constantly in court disputing the price of LNG with taxpayers in a way that they just aren't with crude oil, because there is certainty and stability as to how they deal with that. So that's kind of how you might look to deal with the sales issue in the extractive industries. So the 6th method for hard minerals, for some hard minerals, not all, and perhaps norm pricing for oil and gas. Then switching to how you deal with costs. Financing expense is a major issue for the extractive industries. Excessive interest deduction, so something that you'll all be very familiar with in this case, where you've got a bank lending to the parent company, and then they're putting that money in as equity into the holding company, which then sends it out again as debt to the subsidiary in the producing country. The question is the volume of that debt, how much debt is there relative to equity, and then also how is that debt priced, which is, I think, a bigger concern. Is many developing countries have for some time had thin capitalisation rules in place which say how much debt you can have relative to equity, but far fewer talk about dealing with the price of the debt, the cost of the debt. So either by setting a range within which it might be a reasonable interest rate, or also doing what the OECD has recommended in BEPS Action 4, which is to limit the amount of interest that you're allowed to deduct. So in South Africa, they had actually adopted an interest limitation rule before the OECD BEPS process, so they were ahead of the game in that regard, because they were very concerned about debt pushdowns happening, particularly in private equity, but also in other sectors as well. And so what they decided to do was to limit the amount of interest that you could deduct. So their interest limitation rule is 40% of EBITDA. But along the way, this is quite recent, so they've only introduced this rule, only came into effect in 2015. It applies across sectors, not just to the extractive industries. It's a bit too early still to tell whether it's been effective in terms of curbing excessive interest deductions. I think, however, they have identified some challenges along the way. The first was maintaining a fixed cap, because the idea is at the moment it's 40% of EBITDA that is eligible for deduction. But because of interest rate volatility within South Africa, so between 2013 when they wrote the rule and 2015 when the rule came into force, the interest rate had moved from about 5% to 8%. And so there was some concern about sticking with a fixed cap as opposed to a flexible cap, or a flexible formula. So what they've decided to do now is that the formula is linked to the South African Reserve Bank interest rate. So they calculate it on that basis, so it moves depending on where the interest rate is. Which I think is good for taxpayers because obviously it gives them a bit more flexibility. I think it makes it more complicated for the South African Revenue Service because the timing of the related party debt becomes very important in terms of determining what the amount is that should be eligible for deduction. So I don't think that this isn't a modification that I would recommend to other developing countries that have significantly less resources than South Africa, but perhaps it is a reflection of the difficulties that developing countries may face when trying to introduce a cap like this, is that often it's very volatile with respect to investing in that environment. So that was one issue there. The other thing that's been interesting is its interaction with transfer pricing rules. So the limit on interest deduction is intended to be a hard cutoff, and then if subsequent to that you feel that the rate of that loan is a non-arm's length, then you can embark on a transfer pricing investigation. But I think why this is useful is it just reduces the risk to the tax base and reduces the likelihood that you're going to have to get into complex transfer pricing analyses. And I think pricing debt is probably the hardest thing to do in the transfer pricing space, almost beyond kind of dealing with intangibles. Pricing debt is very difficult. In the Chevron case in Australia, there were both sides, the government and the taxpayer, brought a total of about 15 or 18 loan agreements from independent entities that they thought were sufficiently comparable to the arrangement between Chevron and its affiliate in Delaware to be used as a potential benchmark. The court threw all of those loan arrangements out and said none of them were sufficiently similar. So that shows you, I think, the level of complexity when you're dealing with pricing debt. And so the idea with this is it just limits the risk to the tax base and limits the need to resort to transfer pricing rules. One of the other issues that South Africa's faced is that their rule is very much limited to interest deductions rather than other deductions that might be economically equivalent to interest, so things like foreign exchange losses. So this is something that I think they will look to amend in their legislation, that if you're a company operating in South Africa, you're operating in Rand, the South African currency, and your loan is in US dollars, then you're going to need to potentially borrow US dollars to repay that loan, which means you're going to be exposed to currency fluctuation. So you might want to have a forex hedge. So you might want to agree on how much it's going to cost you to buy dollars in the future to repay your loan. Now, if you do that can create losses, right, which are then eligible for deduction. And in South Africa, they are still eligible for deduction because they haven't been included under that interest limitation rule. And I think that's why BEPS Action 4 from the OECD suggests that interest limitation rules should apply to interest expense and payments equivalent to interest expense, of which foreign exchange losses would be one. The other interesting thing in South Africa has been tax treaty workarounds. So the legislation in South Africa says that this rule only applies to lenders that are not subject to tax in South Africa. Now, that's intended to target these kind of artificial debt arrangements, right? Where you've got the holding company offshore that's been set up to lend into the subsidiary in South Africa. But the problem is, if you take the UK tax treaty between South Africa and the UK, technically, UK companies, those entities that are subject to that tax treaty are subject to the withholding tax on interest expense. It's just that the withholding tax rate is 0%. So there's an issue with companies that, at least UK companies, potentially being able to work around this legislation on the basis that according to the law they are subject to tax. It's just 0%, right? Which is interesting, and it's potentially why a number of the mining companies haven't kicked up that much of a fuss about this in South Africa, because many of them are subject to the UK tax treaty, and you haven't heard that much of a complaint complaint from that sector, which might be why. But so these are some of the ways in which I guess so far South Africa has seen that there might be challenges to what they've begun that require some modification. It's interesting also that South Africa has gone for a much larger, much higher threshold than what the BEPS Action 4 recommends, which is between 10 and 30%. I don't really have a view on that necessarily, but I think it's interesting to look at. One of the things that we're doing in my work with the Intergovernmental Forum on Mining in the OECD is looking at whether we can adapt BEPS Action 4 to be specific to the mining sector. So we're trying to analyse the borrowing levels of mining companies to see what might be an appropriate threshold to set for that sector. Because I think you do need to have some nuance because the borrowing needs of financial services, for example, is going to be much higher perhaps than even the mining sector. And so by having a one-size-fits-all approach, you're potentially allowing some sectors a bit of a free kick and perhaps penalising others. The other example with respect to dealing with costs, so that was kind of the big cost of finance expense. This is a really interesting little adventure that the government of Indonesia is embarking on in the oil sector. So as I mentioned, production sharing contracts are kind of the way of doing business in the oil sector, which is that you take all the oil that's produced, you agree that the contractor is going to take X% to cover their costs, and then the rest is going to be profit oil, which is going to be split between government and the contractor. Now, this is problematic because you have to keep a very close eye on costs, right? Because if you're allowing a share of production to go to the contractor to cover their costs, then you're going to want to make damn sure that those costs are legitimate and accurate, and then that they're not inflated, right? Because if they are, that's going to significantly erode government share of production at the end of the day. So particularly because it's common not to set a limit on cost recovery, so the amount of oil production that you can take to recover your costs, in which case companies can rack up enormous expenses, which mean that government doesn't take any of the oil production away at the end of the day. So Indonesia is the architect of the production sharing contract. So they started this in the 70s. And so it's really interesting that now they've actually decided to move away from that. And so you can see here, so this is the regime that they've had to date, which is you've got 100% of the oil, you've got 40% for cost recovery, 60% for profit oil. So then there's a split of profit oil between the contractor and the government, and then there's some taxes paid by the contractor on their share of profit oil. What they've moved to now is a gross split, which says we don't really care how much your expenses are, how much your costs are, we're just going to split the oil production down the line. So in this case, 57% to government and 43% to the contractor. And then it's up to the contractor to deal with their expenses themselves. So this is good for government because it's in effect like a royalty where it gets paid up front in production before the company has actually recovered its costs. So it's good for them. It also means that the technical expertise that's required to evaluate cost claims under the cost recovery model is very enormous. So a lot of resources go into reviewing the costs that the companies are claiming, which then enlarge their share of production. So you do away with that again to some extent. And in theory, it should make the industry more cost efficient, right? Because under this system, the company is incentivized to be less efficient with respect to cost, to inflate their costs, whereas under this model, actually, the contractor is incentivized to be more efficient, right? Because if it's only getting a share of production and it has to recover their expenses and generate a return out of that share of production, then it's going to do everything it can to minimize its costs. Mm-hmm. So this is the approach that the Indonesians have taken. It's just happened this year, and they've had a bid round for a bunch of new oil blocks over the last few months, and so the question is going to be whether they can continue to attract investment based on this new approach. And that's really all about getting the split right, because you've got to calibrate the split of production correctly between the contractor and the government so as to enable the contractor to still achieve their return on investment goal.
Why haven't production splits been used in mining as opposed to oil?
Have they? Or
why have they not been used very much?
Not really, because this production sharing approach is not common in mining. And I think there's mainly one reason for that, is that oil has a domestic purpose. So countries need oil for domestic consumption, whereas things like copper or some of the more obscure minerals don't have a purpose. So for that reason, governments haven't imposed production sharing arrangements on companies because they don't have a use for it themselves domestically. And the other reason is economies of scale. So I think for government to take a share of production and then try and sell that independently themselves, you're dealing with a much smaller amount than you would be in the petroleum sector. So again, for that reason, it hasn't made sense. But it's something, there are some efforts in this direction. I think part of the interest in having more state involvement in mining projects is that potentially looking at production sharing, where even you could take a share of production and just sell it back to the company, and then they sell it onwards, in which case you might overcome that kind of economies of scale issue. So this is an interesting experiment in Indonesia, which I think a lot of oil producing countries, particularly developing countries, are watching very closely because they are deeply concerned about mounting cost claims from oil and gas companies eroding their share of production. So in Indonesia, for example, in 2016, the Supreme Audit Institution in Indonesia did a report into the sector that found that companies had been inflating their cost claims by about $300 million. Again, in 2016, the amount of the oil production in value that went to cost recovery, so allowing companies to pay themselves back, was about $13.9 billion, which was more than the government made from the sector. So these sorts of things make cost recovery a pretty hot topic, and this is an interesting approach if you can avoid that altogether. Government just takes a share of production and deals independently from the contractor. Just the last couple of examples and then we can have a discussion is moving now to the role of institutions. So we've talked, there's a few examples there, 4 examples of different kind of tax policy approaches with respect to sales and costs, and what role do institutions play. The issue, as I explained at the outset, I think in the extractive industries is often this kind of fragmented approach to tax administration in this sector, where, for example, you've got the Revenue Authority. Within the Revenue Authority, it's common now to have an extractive industries audit team. You might also have an international tax team that is embarking on transfer pricing audits in relation to mining oil and gas. There is no cross-fertilisation between those two units. So no exchange of information and expertise, which can create a range of issues. And then even with outside of the tax authority, within the government agencies involved in regulating the extractive industries more specifically, you might have a minerals commission, oil and gas commission, you might have a state-owned oil company in the oil and gas sector. So you've got lots of moving parts, which means that often the information and expertise that exists in silos and isn't shared. So for example, the tax authority might not have information on production, the people in mining might not have information on tax payments and so forth. And I really think that given the complexity involved in dealing with transfer pricing issues and complex corporate tax avoidance, the need for a kind of joined up holistic approach across government is really very crucial. So this is the challenge that we see in lots of developing countries. So what are some of the approaches to addressing this issue? So this example is from Sierra Leone, where a few years ago they started an extractive industry revenue task force. The reason that it began was to try and participate in the Extractive Industry Transparency Initiative, which is a global initiative to try and improve transparency with respect to the amount that companies are paying in taxes to governments and the amounts that governments are receiving in return. So that was why this task force formed, was to try and produce reports for that. But then over time they realised that it was very valuable to them. So it's a technical level task force that's housed by the Ministry of Finance and includes actors from across relevant agencies within government. What do they do together? Now they do joint audits, which I think makes a lot of sense to have people from the mining ministry, people from the tax authority join together and actually go out and do tax audits of companies, because then you're bringing together that industry expertise with the tax expertise to make a much more powerful combination. One other success that they've had is there was a lot of issues with the smuggling of gold generally in West Africa, but in particular in Sierra Leone, because they had an export duty on gold that was quite high compared to their neighbouring countries, which meant there was an incentive for people to smuggle gold into Guinea or Liberia and then pay less in export duty on the way out. So this group, recognising that, worked together to slightly reduce the export duty in line with neighbouring countries. So now you're seeing a lot more gold leaving Sierra Leone than it was previously, being funneled out through various neighbouring countries. One of the issues still in Sierra Leone, at the beginning I explained the politics of the place, but in my experience, these kind of task forces work very well at the technical level. The problem is still trying to bring together the political leadership to be united behind some kind of common vision for the sector. That's very difficult. You have mining investors that will come into the country that will go and see the Minister for Trade, the Minister for Mines, the Minister for Finance, and obviously there's going to be opportunities in each of those places with respect to the investors and also on the part of the government to engage in corruption. So political will to support interagency coordination is still a really big challenge in Sierra Leone, despite the fact that this technical task force is working very well. And there is a lot of goodwill and willingness to work together at that level, but the politics aren't always right. So that's a problem because obviously you can only get so far at the technical level. As I said, when in my role supporting the mining negotiations team, I would regularly write very reasonable memos to the president and others that were generally thrown away, I think, because they weren't what they wanted to hear. So it's a bit similar with this technical task force. And the last one is an experience from Tanzania. So this is from the research I did in 2015 in these 5 countries, which just shows you the number of mining tax auditors and mining professionals in the tax authorities in these 5 countries. So you can see that of the 5 countries, Zambia is the only one that actually has some mining industry professionals within the tax authority, but then more generally, these are the numbers of mining tax auditors within each of these authorities. Why is this interesting? Well, as the gentleman from Tanzania said, that we know our tax law, we know how to apply it. The issue is understanding what is normal extractive industry practice and what is abusive. And I think this is the issue for tax authorities, not just in the extractive industries, but in telecoms or whatever sector, is often they're there and they're trying to regulate sectors that they don't understand ultimately. And so their ability to pick up on issues and to then evaluate the level of risk associated with those issues is really limited by a lack of industry expertise. And I think that is particularly acute in the extractive industries because it is a highly technical sector. And often very politically sensitive. So this is the issue of the lack of kind of industry expertise that's being brought into tax audits and just generally understanding tax arrangements in the sector. So the Tanzania Mineral Audit Agency was set up by the government of Tanzania in 2009. So the government of Tanzania was very concerned that it hadn't been collecting a lot from the gold sector in particular, and it felt that the reason for this was that it didn't have the capacity to monitor the sector effectively in terms of the sale of mineral exports abroad and also on the cost side. So they set up the Tanzania Mineral Audit Agency, which was a semi-autonomous government agency that had this remit to look at sales and costs. It was quite interesting because previously they had contracted a private firm, which is called Alex Stewart Assayers, to come in to audit the gold industry, but there was a lot of corruption involved with the giving of that contract to that private firm, but also the cost involved in contracting a private firm to do this work on behalf of government. This private firm, their fees were 64% of the total royalties that were collected by government from the gold sector. So it didn't make a lot of sense, so they set up their own government agency which performs these functions and has been enormously valuable to the sector in terms of building out industry expertise, and they spot issues and then they sit with their colleagues at the tax authority on a quarterly basis to kind of raise their attention with respect to some of these issues. And what have they achieved? Well, this is since they were established in 2009 in terms of the share of corporate income tax, revenue and the value of the exports, and the corporate income tax received, and the total value of precious metal exports. So you can see here in 2010, the Tanzania Mineral Audit Agency recognised that there was a problem with mines offsetting costs against one another. So say you have a mining company in Tanzania that has 2 or 3 gold mines. Maybe some of those gold mines are older and have been producing for longer versus those that are newer. So what you might do is move the cost from the newer mine over to the old mine to reduce your taxable income in the old mine and pay less tax. Right? So this is a common problem in mining and in oil and gas, and so the response is then to ring fence those mines, to say, okay, you can't aggregate income and losses across these mines, instead they have to be treated separately, so as to prevent that from happening, because what that does is then defers taxes for government on the older mines that should be paying taxes. So this was something they picked up, which meant that they were able to collect a lot of additional corporate income tax by introducing that policy. Also dealing with hedging. So I mentioned earlier, I think it's not uncommon to see mining companies engaging in a hedging arrangement with a related entity, but basically they're saying, we're going to agree to sell you our product at this price for the next 3 months. And they set it at the bottom of the price cycle, which means that they're constantly recording hedging losses in the producing country, which reduces their income and they pay less tax. And often they've entered into exactly the same hedging arrangement between the entity that's purchasing the product and a bank, which mirrors that, which means that the profit is accumulating in the entity that's purchasing the product from the mine in Tanzania. And so hedging losses are being recorded there. And then the solution is to impose separate tax treatment, which says you can hedge all you like, but those hedging losses and gains aren't going to be included as part of the business income, which means that the incentive for companies to engage in abusive hedging or artificial hedging goes away, because the reason that you do that is to reduce your taxable income. So again, this was something that they identified that they were able to address with their tax colleagues. So I think the really great thing about Tanzania is that you've got this audit agency that has enormous industry expertise, that has a mineral laboratory, people that are specialised in testing mineral exports and so forth, as well as doing cost audits, and they then work with their colleagues in the tax authority to kind of raise alarm bells when they see practices in the industry which they think their colleagues in tax seem to be aware of. And this is actually really important, because in the extractive industries it's often quite late in the game that the tax authority gets involved. So if you've got a mine that's come in, they've explored, they've decided to develop a mine, it might be many years before they actually start paying income tax, because their losses are enormous and they're allowed, but they're given various allowances, depreciation and so forth, which mean that a lot of costs have been incurred which will subsequently be offset against income tax that the tax authority themselves haven't begun to investigate or audit when those costs occurred. So actually having an agency within government that is paying attention and is providing oversight to the sector throughout the process, particularly early on, is really important, because otherwise the tax authority is likely to have missed quite a lot that might have happened before they really come on their radar or they start caring about them. So I'm going to stop there because I've talked for a while and I want to hear from you guys. But this really, my proposal is, there are 2 areas of risk in the extractive industries with respect to transfer pricing. One is the sale of the product, and then one is the services and the inputs that you require. And I think already across these countries that I've highlighted today, there are lots of examples of alternative tax policy rules and kind of administrative practices that can be put in place that start to reduce the risk of transfer pricing in the extractive industries. It doesn't eliminate risk, but it certainly makes it a lot harder. And I think this kind of piecemeal approach and really highlighting practices from developing countries that are innovating in this space is an important one, because I think it holds out a little bit more hope perhaps than some of the larger proposals that require global consensus and so forth. So let me stop there, and any questions and comments, reflections that you have. Yes.
This might be more of a slightly biographical question, but I was just wondering how you went from studying law to working in a place like Sierra Leone, because this is the kind of thing I'm really interested in, but I often don't hear about people going from law school to stuff like that. So I was just wondering, is that common? How did you end up doing that?
Okay, great. Thank you. I saw 2 other hands. Maybe if I take them and then I can just...
My question was, are governments listening to you? I mean, are your proposals making any headway? Do governments like actually implement the things that you recommend?
Okay.
And if so, or if not, why?
I guess my question is more technical. It's like, so if the commodity we're dealing with is labor, for example, something that's very flexible, if you put taxes on one jurisdiction in Africa, the companies all said we're just going to go hire people in a different jurisdiction that have lower taxes. And I was wondering to what extent that applies for a commodity that's less flexible, like mining. If there's a lot of gold in one place, you can't just say we're going to go mine it somewhere else, but to an extent you can. So I was wondering to what extent that is occurring.
I just have one question. Generally speaking, most of the information that you require to sort of create transparency and adjustment relies on information. And I think you alluded to 2 examples about where the information is either really expensive in terms of the court case of Chevron, for example, which costs $10 million, and the other where the information, for example, of a Chinese parent company who just don't know the information. So what is the practical, your comments, your thoughts on when you just can't get the information? And secondly, when you rely on information that sometimes is not accurate, does that not create a discriminatory practice, for example?
Okay, great.
On the list, is there a global estimate of how much all of this is worth in terms of non-compliance? You know, because normally when we do tax compliance strategy here, we would look at, you know, here's the opportunity if we really enforce the law, and here's how much evasion there is. But has anybody bothered to take a shot at, you know, is it $1 billion? Is it 10 billion? Is it 100 billion? What's on the table here in terms
You
of
mean the scope of tax?
the scope of potential revenue gain for developing countries? Is anybody taking a swag at that?
So perhaps I'll start with that. The answer to that is no. In the extractive industries, no one has taken a stab at coming up with a global estimate for tax avoidance in the extractive industry specifically. Obviously, there are estimates for like corporate tax avoidance more broadly, so the IMF estimate, which is 500 billion and 200 billion for developing countries specifically, but no one has done this for the extractive industries, and I think it might be something that we need to do within our scope of work with the Intergovernmental Forum on Mining, which is my main client these days, is actually come up with a figure for
How much is this worth?
how much is it worth, because I don't think we know.
I mean, if it turned out that, you know, it was just $1 billion, it would be a different implication for you.
Yeah.
And, you know, worrying about all this is important, but it's not as important as it.
I think there's some strong anecdotal evidence, right? So if we were talking just before about the difficulty is that so many of these cases actually never get to court and they're negotiated out of court, and so the availability of information with respect to those settlements is limited. But if we just look at a few cases, so the BHP case in Australia, which is still kind of in progress, which is in relation to their use of their marketing hub in Singapore, where the Australian Tax Office is disputing the commission that the mine in Australia pays to the marketing hub in Singapore. It's on the basis that the marketing hub in Singapore doesn't actually add that much value, and so therefore the remuneration shouldn't be as high as it is. In that case, we're looking at about $1 billion at stake if the Australian government wins that case, that they are suggesting should be attributed to the mine in Australia. So that's a pretty significant sum of money in one case there. In the Chevron case, again in Australia with this intercompany debt issue, the adjustment there was about $400 million, and it's going to have a flow-on effect in future years with respect to Chevron's ongoing financing arrangements. So it's an adjustment looking retrospectively, but then also moving forward it will have implications.
So these are $1 billion per year, $400 million per year.
So no, the case with BHP is a one-off sum
Okay.
of $1 billion. The case with Chevron again was a one-off sum of $400 million, but the Australian Tax Office has suggested that it's going to be significantly more than that over time as a result now of that adjustment. Then there's another case in Uganda with Tullow Oil and Heritage Oil. So basically you had Heritage Oil had a license to an offshore oil field in Uganda. They were looking to sell their interest to Tullow Oil. They knew that the government of Uganda was looking to introduce capital gains tax that they would then be subjected to, and so before that happened they restructured their investments so that they set up a holding company. I can't remember through which tax haven, but it was a tax haven that had a treaty arrangement which meant that capital gains tax didn't apply. And so they did that deliberately to avoid capital gains tax. That was about $400 million. Now what happened is Tullow bought out their interest, and what the government of Uganda did quite correctly was to say, well, someone has to pay capital gains tax here. We don't care if it's you or Heritage Oil, but we're going to suspend your license until someone pays. And so Tullow Oil paid that $400 million in capital gains tax. It then sued Heritage Oil in a UK court to recover that cost to them. So again, that's $400 million there. So I think, and there's a case in Canada going on at the moment as well. So there's a few cases in the extractive industries which start to give you a picture of the sums that are involved. And I would speculate that they are far higher in developing countries given the lack of vigilance and oversight traditionally from governments in those countries. I mean, if Chevron Australia thought it could get away with pricing its debt from its affiliate in Delaware by an additional 7%, then, you know, and this is the Australian Tax Office with 1,000 people working on intelligence, then you can only imagine what companies think they can get away with in developing countries. I would speculate. But so that's the answer to that question. I think the question that you asked about kind of mobility of mining investment, which I think is a very interesting one, because the theory suggests that tax treatment should matter less for mining and oil and gas because you're dealing with a fixed asset. So you can't move the asset, so therefore kind of tax holidays, tax breaks, etc. are going to be less relevant or less decisive for a company in terms of making an investment. If the asset is really good, then you pay what it takes, right? So that's the theory, is that you're dealing with kind of location-specific resource, and so that should be less affected by taxes. I think in practice, that's not necessarily the case. I think countries are competing for capital in the mining sector and in oil and gas. They do have to be mindful of how competitive their tax regime is. And this is, I speak regularly with tax directors in mining companies, and they are generally weighing up investment proposals between different countries. And ultimately, the asset is the most important thing. How good is it? And tax is not the decisive factor in the same way that it would be, for example, in labour with like manufacturing and that kind of thing. So they are, you know, you are competing for capital, so it is relevant. I think one of the pieces of research that we're trying to do at the moment is looking at the use of tax incentives in the mining sector, how prevalent they are, what kinds of incentives are at play, which types of incentives make sense, because just because you have to compete for capital doesn't mean you have to kind of give up your tax base. You want to be strategic and smart about where you do need to incentivize investment versus instances where you don't. So this example in Cote d'Ivoire, where in their legislation they offer a 5-year tax holiday, there's a particular mine that we've built a financial model of this mine and the impact of that tax holiday on government's take from the mine. And what you can see is that the internal rate of return for that mine, that gold mine, is so high, is about 30%, which is significantly higher than what you would expect or what you would see in other similar gold mines, that even when you remove the tax holiday, their internal rate of return is still so high that that was a redundant tax holiday. You didn't need to offer that, right? which is hundreds of millions of dollars down the drain for the government of Cote d'Ivoire because no one the modelling at the outset, right? And this is a big issue in developing country governments, is that no one is building financial models in order to make better decisions about incentives. So really looking at, on a case-by-case basis, does this investor actually need a tax holiday in order to meet their kind of hurdle rate, or is it redundant? Because, and that's actually where some degree of discretion about incentives is important, because often people say, well, actually we want all the incentives to be in the law and for there not to be any discretion because of corruption. But actually the flip side of that is then, well, if you're going to offer something and then it means that the marginal projects that it was intended to benefit almost benefit the least, if you like. It's really the guys that already had very profitable projects that benefit the most from that tax holiday. So this is something that we're looking at, is how do you make better decisions on a case-by-case basis, and what types of incentives make sense for the sector. So again, a tax holiday doesn't make sense because a tax holiday is relevant for kind of footloose capital, right, that can move anywhere. A tax holiday is nice to have, but the things that are important in the mining sector are how quickly can you recover your costs. So things like depreciation allowances, that kind of stuff, are what really makes a difference to a mining investor than a tax holiday. So this is what we're looking at, is what incentives make sense, what are you actually competing on, because there clearly is a perception that they are competing. So rather than just saying don't offer tax incentives at all, we need to respond to that, but rather help governments to kind of make better decisions about incentives. Your question about do they listen? I think yes, I think they do listen. I'm still pretty new in this space. I've only been doing this for kind of a few years. So I'd probably come back to me in 5 years' time and it'll be a better assessment of whether or not I'm having much success. But I think they are. I think there's a lot I think developing countries recognise that they have a lot to learn in this area. So by having people like myself and others that can come in and sort of put out on the table, hear what different countries are doing to try and address this problem is helpful for them, because they can see that there are options, and trying to help them recognise the trade-offs between those different options. So I think some of the areas where we've had success, which are a little bit easier to be successful in, are things like transfer pricing documentation rules. So the work that I've done, I think, has been helpful in a few countries in getting them to introduce documentation rules, getting them to introduce specific requirements for the extractive industries, so that you're really asking for the right kind of information from taxpayers rather than just any information you've got. Those kinds of things are helpful. Some other work that I've been doing this year, which I'm really excited about, is helping train tax authorities on risk assessment. So I published earlier this year a toolkit for transfer pricing risk assessment in the mining industry, which basically helps tax authorities identify and evaluate particular areas of risk in the mining sector. So it sets out pretty clearly kind of, here's the information that you would need to request and where you might be likely to get it from. Here's are the types of questions that you would need to ask the taxpayer. Here's how you might start to evaluate the response that they provide and the most kind of salient issues and so forth. And that, I think, is bearing fruit. So we've done that training now in a few countries, and next year we've got like 10 African countries that have requested training on that. And I think that's an area where I feel quite confident that we are going to make some headway, because actually offering a structured, methodical approach to dealing with transfer pricing risk, I think, is valuable. It shocks me how many people I meet in tax authorities who really just accept what taxpayers have to say at face value. And it says a lot about the power dynamics, particularly in developing countries, between taxpayers and tax authorities, is they'll say, oh, well, the mining company has told us that the marketing hub that purchases the mineral product from them is taking on all legal risk, right? That the reason why we're paying this marketing hub so much in a commission is because they've assumed all this risk and exposure and so forth. When in actual fact, what often happens is the mine sells the mineral product to its marketing hub, right? And then in a split second, that sale, they then sell the same product on to the independent customer. So it's called like flash title, right? Where the legal ownership of that product changes hands within a second. And so to say that the marketing hub is actually exposed to any real substantive risk in that instance that should justify remuneration from the mine is a difficult argument to make. And this is something that South Africa has been dealing with as well in the mining sector. But what they'll do is the tax authority will say, well, hang on, the contract that they've given us between the mine and the marketing hub says that they're taking on all this risk. So, well, that's reasonable. They should be able to get a 5% commission. It's like, well, guys, let's unpack this. Let's be detectives here and let's have a structured approach to asking questions and going through the evidence and so forth, so that we can actually build a position from which to then go back to the taxpayer and ask the right questions. So actually that alone, I think, is a useful contribution that I'm seeing kind of bear fruit with the tax authorities that I've worked with. Your question, Imran, about getting information. So, I mean, I think, this is the kind of big stumbling block, really, is the difficulties that developing countries experience when trying to get information. And we were talking about this earlier, that actually some of the issues I've seen with tax authorities is just that because they're not doing risk assessment, because they're not figuring out what the right questions are or what the information is that they should request, they go to their counterparts in tax jurisdictions elsewhere and say, give me all the information you've got on X mining company. And quite rightly, that tax authority in that other jurisdiction says, well, I'm not going to give you everything we've got. And even if I did, it's like finding a needle in a haystack, So, and I've spoken with people in Kenya in the Kenyan tax authority, who will make requests to the taxpayer, and then they'll come back and they've got an entire room that's floor to ceiling papers, again, because they haven't asked the right questions. And so it's very easy then for the taxpayer to confuse the tax authority. So I think for me, one of the things I'm really passionate about is, before we ask for information, let's be very clear on what are the questions that we're trying to investigate and what information do we need to answer those questions, so that we have a greater chance of actually getting information back from other tax jurisdictions. I think, though, more generally, there's a lot more that tax authorities can do with the data that they already collect that they're not doing currently. So, for example, in Zambia, something that they've started to do is build their own internal database within the Zambian Revenue Authority based on the data that they collect from mining companies. And it's pretty clear there are some really common cost categories in the mining sector that are standard across the sector, particularly when you might be dealing with one or two commodities, right, where you're going to have similar patterns in terms of operation. If you can start to build your own database, at least insofar as risk assessment, if not audit, that's really helpful in creating your own internal benchmarks. So I think that's an area where we can do more. And I think then you start getting into the territory of secret comparables, which everyone gets kind of anxious about whether you can use secret comparables, right, which is basically taking data from taxpayer returns and so forth and using that as a basis for adjustment. Countries like China do it, but that's because they have such a large market share that they can basically do whatever they want when it comes to international tax. But I think it's something that developing countries can consider as well, is at least how to make better use of the information they already have available to them. And I think in the mining sector, you and I spoke about information collection being so diffuse. Again, this is an area where greater coordination between the relevant actors is helpful in terms of painting at least a more comprehensive picture of how these companies operate and what the risk areas might be, and therefore what government should be monitoring. So, I mean, it's not a perfect solution, but I think it's something that we could pay more attention to, is just actually how do we use what we have? Because again, developing countries, everyone likes new shiny things, so everyone wants a subscription to the international transfer pricing databases and so forth, which is fair enough, and I think that's something that development organisations should fund. But how can we as tax authorities use what we have better, rather than always looking for the kind of quick fix? The last question is, how do I find myself doing what I'm doing? It's a long story. I'm not sure you really want to hear all of it, but I think I started out, left law school, went and worked as a lawyer for a while, and then had always wanted to work in international development. And so I actually started out working in health and education, had nothing to do with tax, and found myself trying to push governments in different developing countries to spend more money on healthcare. And realised at the end of the day that they probably would spend more money on healthcare if they had the money in the first place. Now, that's not a given, right? Because a lot can happen between collecting revenue and spending on healthcare. But I realised that the problem was domestic revenue mobilisation, and so that was a problem that I wanted to help fix. And I think collecting revenue from multinational corporations is a good place to start, especially given that many developing countries, personal income tax isn't really a big source of revenue. And I think there's also an issue for me, something I find interesting is how do you improve accountability between citizens and state in developing countries. Because often there's a lot of kind of upwards accountability between governments and donors, but very little between governments and citizens. And I think that's because, the social contract is not working as we would like, and I think tax is a really important aspect of the social contract, and citizens aren't paying taxes in low-income countries, not necessarily because they can't, but because they don't see any return on their tax dollars, which I think is an issue. I think if you're going to tackle that issue, you have to at least be able to say confidently that you're collecting taxes from multinational corporations, because unless you have that, you don't really have a leg to stand on as a government with respect to trying to enforce tax collection from citizens and thereby improve that kind of accountability. So that's kind of my personal journey. It was just international development, and then actually it was kind of later on that I came to realise that tax and international tax was really important. So I'd be happy to have a further conversation with you if that's useful. So I think, yeah.
I think it's a good example of how once she started out with that intention of helping developed countries in the area of healthcare and social justice kind of issues, she realized that the real problem was in mobilization. And then when she started working in Sierra Leone in 2007 in the extractive industry sector, in 4 years she had developed tremendous skill sets in that area, and then it became replicable in other countries. So once you master a certain art or a knowledge base, and it's clear that other countries need it, then it's a matter of continuing to build on that platform and then exercising it in many other forums, which is how her marketability and her access to governments has increased dramatically, because building layer on layer of that expertise coming from an intention that was important. More questions?
Can I get in with the question?
Yes, please.
Hi, Thomas.
Hi, Alexandra. So first, let me thank you very much for doing this and saving me a trip, actually 2 trips across the Atlantic, so fantastic. Wonderful presentation. And the other thing is, I mean, the more I hear your arguments, the more I find this tender option attractive. And let me say why. So the problem really is that these developing countries are selling the resources at too low a price. So what that means is that the companies that are harvesting these resources would be willing to pay quite a bit more, and they would still be very happy and they would still be making a wonderful profit. So the question is, these countries have an information deficit. They know much less than the corporations. They understand the business worse. They don't know what the corporations are doing downstream and so forth. And so, since they don't have that information, if you can somehow get these companies to bid against each other, you should be able to get them closer to the point, to their reservation price, to the maximum that they would be willing to pay and just barely be happy. And an additional advantage is that the countries could design the lots. They would have complete control over the lots. And by lot, I mean not just the geographical space in which extraction takes place, but also all the conditions, right? You can take out so many tons of ore, or you can, whatever conditions the government wants to impose, they can define a very complicated lot and then say, this is the lot that's up for grabs, and anybody who wants that lot can bid for it. And they can, in addition, also be flexible on the bids. So they can say, rather than bidding a certain dollar amount, this is how much we are willing to pay in terms of both taxes and payment for the resources. They could also say it's going to be, in one sense, a function of the price. So, for example, the price of the resources over the duration of the lot is, let's say, 5 years. We monitor the price, take the average price over the 5 years, and we make the payment in some way depend on the price. This would make the deal a little bit less risky for the company, and would also give the country an opportunity to participate in any increase in the price. So there's all that flexibility about the defining of the lot and the defining of the payment and so on. And I wonder whether this wouldn't be the way to squeeze out extra value. The one thing that is obviously problematic is the possibility of collusion, right? So you have companies that would say, okay, I let you win this time and you let me win next time. But currently, with the Chinese being in the business, and there's a lot of players in the space of competing for resources, and so I hope that one could keep the collusion down, and one could also, of course, allow the government not to accept any bid. If they think they're being lowballed, they just say, sorry, no, we keep the auction in half a year, and we are not going to give it to anybody this time.
So I think it's a great idea. I think the main constraint, and I think it's something that a lot of developing countries are keen on as well, right? Which is why there's been a big push to try and get donors to support geological surveys so that governments themselves have more information about the resources under the ground so that they're in a position to engage in a bidding process. So bidding happens regularly in oil and gas, but it doesn't happen so much in mining. It happens in oil and gas because the investors will come in, they'll bid on the blocks that are available, usually because the government has a state-owned oil company that perhaps has some exploration or seismic capacities to be able to determine the scale of resource that's contained within the block, and so it makes the bidding process easier. So we need to see the same process happen in mining, so the governments actually have the information to be in a position to, I think, open a tender for their resources. So I think if we could overcome that hurdle, which I assume we can, because developing countries have been able to overcome that constraint with respect to oil and gas. So for example, in Liberia, the Liberian state-owned oil company does some degree of exploration, seismic studies and so forth, so that they have a whole lot of data that's available to investors to come in and take a look at, to then inform a bidding process. And I think the investors pay for use of that data, which helps to remunerate government in terms of the costs involved in doing those surveys in the first place. So I think there's been some success at doing this in oil and gas, and it would be interesting to better understand why and how they've been successful, what are the conditions for success, and how that might be replicated in mining to run a similar process. I think the other issue, as you identified with respect to price fluctuation, is significant because volatility can be quite enormous, and so how you deal with that is going to be important in a way that is not overly complex as well, because again, something you see increasingly is governments wanting to benefit when prices are high, and so they have a royalty rate that's linked to price rather than just kind of the gross production. And that can sometimes be difficult because if companies are able to make various deductions and so forth, they can game the system so that they always stay within the lower price bracket so that they pay a lower royalty rate, for example. So that's something that we've seen with respect to royalties, where they've tried to link it to price, and that has been introduced an element of complexity for tax administrations that has been sometimes difficult.
Take the official world market price.
But there isn't always an official world market price. So, as I showed with respect to the sixth method, is that certainly I think it's clear that there are some mineral exports that is much easier to deal with, both with respect to applying the sixth method or having kind of the approach that you're advocating for. But I think there are a whole lot of intermediate products or kind of more rare specialized products where there isn't necessarily a world price for them. So, but the reality is that that's a challenge irrespective of whether you use kind of a bid process or otherwise, right? That's just that's the cost of having kind of intermediate mineral products or specialized mineral products that you're going to have to deal with regardless. So I think it would be interesting to explore, as I said, how it's worked in oil and gas, because it seems to have been relatively successful to have kind of bid rounds in oil and gas and give government more control over the resource than it has in mining. I think you had a question as well.
Yeah,
So-
when looking at different ways to price things, what are the differences between government set norm prices, sixth method, benchmark prices, and then comparable uncontrolled prices in terms of like the actual value, and then which ones are appropriate to different situations?
Okay.
Just like
Yeah. Were there any other questions, Polly? Okay, great. So what are the differences? Okay, so the sixth method is using the publicly quoted prices, right? So that only works if the mineral product is traded into terminal markets and so has a world price. The norm pricing approach is where the government comes up with a price which is going to be based on a number of factors, one of which will be a world price if there is a world price. So in the case of crude oil, there are a number of price indexes for crude oil, so that is a factor which is then adjusted for the quality and the specifics of that oil field. So that's where government tries to basically come up with its version of an arm's length price. So that's how those two are different. In terms of how either of those are different to a comparable uncontrolled price, the comparable uncontrolled price is the price of a similar transaction between similar independent entities. So that's really where the world market, the world price, the London Metals Exchange price is pretty close to a comparable uncontrolled price. The OECD would argue that it's not, but they have already in the BEPS actions made some concessions around that to say that you can use a publicly quoted price as a cup with some adjustments for some of the specifics that I mentioned that governments take into account within norm pricing, which are the quality of the export, transport costs, particularly contractual terms and so forth. So the OECD has said, so this is kind of the OECD's way of kind of giving the nod to the sixth method, which it doesn't want to give the nod to. So they've said you can use publicly quoted prices as a cup, but you still have to make various adjustments to make it kind of properly arm's length, which is missing the point of why developing countries opted for the sixth method in the first place, is because they do want to try and steer clear of those transfer pricing analyses that are required to come up with a cup. So I think those are the differences. I think it's pretty clear that why would you use the cup approach when you can use the sixth method? In my view, for a developing country, I think it's pretty easy to make the argument in favour of the sixth method. It's not particularly dissimilar from the comparable and controlled price method, given the concessions that the OECD have made now around that. So if you're dealing with a mineral export that has a world price, use the world price. You're probably going to be forced to make some minor adjustments for quality, but really that's the only concession you should be willing to make, because it's not fair for a company to have to pay tax based on the London Metals Exchange price for iron ore at 62% iron content if you're only selling a product that's 50% iron content, right? That's really unfair for a company. So you are going to have to make some adjustments there. But I think the sixth method is entirely appropriate for minerals that have public prices, and I think the norm price, again, is a good approach, and it could be applied to mining as it is already to oil and gas. I think bearing in mind the credibility issues and some of the complexity issues with actually having to come up with a government-derived price as opposed to the sixth method, which just takes an index price, which is a lot more straightforward and perhaps easier to justify to companies, whereas with the norm pricing system, you're going to have to make sure you do have some level of expertise to be able to come up with your own price. Otherwise, it might discourage investors. So I think both of those approaches need to be managed quite carefully in terms of the credibility of the institution and the level of expertise that's required. So it might involve even bringing in the private sector. In Norway, for example, they have 2 independent consultants as well that they use to provide technical information to the Petroleum Price Board, in addition to the group that actually ultimately set the price, because it's difficult to have all of that information available to you. So I think it's pretty clear that those approaches are preferable above and beyond the cup method for developing countries because of the constraints that they face. I think that, however, they're only going to be useful for a certain subset of minerals, but that is valuable. Is definitely valuable, because it means then for the more difficult ones you can invest more time and energy in trying to understand how those are priced, and coming up with other formulas, for example. So another example is when you're dealing with intermediate products, so things like metal concentrates, or things like, take something like bauxite. So bauxite is the material, is the input to produce alumina, which then produces aluminium, right? So there is no public price for bauxite, and bauxite is a massive commodity. So for example, Guinea is the largest producer of bauxite in the world. So the fact that there isn't a price for bauxite is a problem for Guinea, so they then have to work out how to come up with some approximation of an arm's length price for bauxite, given that it is being sold within a vertically integrated company to the alumina refinery and then to the aluminium refinery. So one approach there is to say, okay, we're going to come up with a pricing formula that says you have to use the publicly quoted price for alumina, which there is one, and then we're going to allow you various deductions for treatment and refining costs for transforming the bauxite into alumina, because we know generally what those costs are. And then we're also going to allow for some deductions with respect to impurities. So for example, if the bauxite has a very high moisture content or silica content, or these things that mean that it's more intensive, energy intensive to transform it into alumina, we're going to basically come up with a formula that allows for set deductions based on these factors. So you're going to have to use a publicly quoted price that we can all say this is the price, and then we're going to agree on deductions based on these parameters. So that is how you might come up with a pricing formula for an intermediate product for which there isn't a world price for that specific product. So these are, might help you to then start to address the same issue for some products that don't have a clear index price. Yes.
You said that in, I don't know how to pronounce it, Cape d'Ivoire or some country.
Côte d'Ivoire? Yep.
Yes. There was a lack of financial modeling which led to a $100 billion tax break. And you said, why didn't the consulting firms jump on that and say, oh, listen, we'll do the financial modeling for you? Why wasn't there the financial modeling there?
I think, I don't know, I think that, well, firstly, governments haven't necessarily invested in that expertise, so they don't have it in-house, but as you say, why didn't a consulting firm see an opportunity there? I think now they will. I know a lot of consultants that are now providing support around financial modelling to governments. I think it was just a question of not knowing that this was going on. I think also governments are perhaps understandably reticent sometimes about engaging private consultants to do this sort of work for them. I think they would prefer that they had that expertise in-house. So that can sometimes be an issue, getting them to actually hand over the information that you need to build a model. But there's a really interesting group that, if you're interested in financial modelling in this sector, worth checking out. They're called Open Oil, and they're based in Berlin, a small consultancy, and they have basically gone about now building financial models of a number of mining, oil and gas projects around the world based on publicly available information. And it's been fascinating to see how close they can get to reality just based on the information that they can actually gather publicly. So not even getting the governments involved, but then once they've built the model, sending it to the companies that are implicated, and the response that they've got from companies 9 times out of 10 has been like, you're pretty close to the truth there, which is interesting just to see. Yeah. And again, this is something tax authorities talk about, information that they don't use, financial reports. Tax authorities are rubbish at making use of information that's in financial reports. So again, something that I'm really interested in, which I think would be a really good service, is how do you actually just go around and help governments to, let's gather all the financial reports that are relevant for these 5 top mining companies and start to harvest data from them and see what we can use, right? Because there's often low-hanging fruit here. I've seen in Sierra Leone mining companies say one thing to the government with respect to their return on investment, their proposed return on investment and so forth, and then say the opposite on their website to their investors. Yeah. Just really basic stuff where if you put 2 and 2 together, it just puts you in a stronger position. I think often these companies take advantage of the weak government oversight to do really basic stuff that governments can pick up on. So what Open Oil have done is really interesting, and now they're getting a lot more traction with governments to go around and actually offer financial modelling training and actually help governments build their own models. Because also the IMF has been notorious in this space for coming in and building financial models on extractive industry projects, but it's not open source modelling. You don't know how they build their models. They leave them and no one in government knows how to use them, and so they come back, 6 months later they update the model, great, but what use is that to the government in terms of actively monitoring the company? So I think the kind of approach that Open Oil offers, which is very kind of open source, it's based on the FAST modelling standard, which is something that people, I understand, know about. I'm not a financial modeller, but so I think there is more appetite for this sort of work now, because it was very evident in that case that, if someone had just built a model, they would have seen that that company really didn't need the incentive to get them over the line.
I have one question. Why are all this mining companies, all the trading companies in the world based in Switzerland? And how much value added are they bringing to this party? What part of value do they capture? Is it
Yeah.
some sort of roughly?
An enormous amount. So this is something I've potentially got to do some work with the Swiss government, looking at the role that Swiss-based trading companies play in the extractive industries, in particular any tax risks that they pose to producing countries. So by trading companies, I mean groups that their business model is just to buy and sell production. So they don't own any mines, they don't have any oil fields, they just buy from one mine and they sell to another, right? So that's their business model. It's very low risk, it's very high reward, and they capture a huge share of market value as a result. So I think somewhere around 35% of oil and gas sales take place through trading companies in Switzerland, and over 60% of all mineral and metal sales in the world take place via trading companies in Switzerland. So it's an enormous commodity trading hub, primarily independent trading companies, which are really interesting because they're different to an integrated company, which is primarily what we've been discussing here, right, where there's very clear kind of transfer pricing risks and so forth. But the thing with the independent traders is that they don't necessarily have a taxable presence in the producing country, so they don't have any taxes to avoid in, say, Ghana or Mali or whatever. It doesn't mean they're not trying to reduce their global tax bill in some shape or form, but it's not clear that it has an impact in producing countries. However, what we're exploring is kind of, are there any tax risks even though they don't have a presence there, which we think there might be because, for example, it's common for traders to give finance to a mine in return for a share of production, like over the long term. So you say, this is a mine in financial distress, it needs finance, we're going to give you $100 million, in return for which you're going to sign a long-term offtake agreement agreeing to give us 30% of your production of copper for the life of the mine at this price. And then the question for the producing country government is, well, is that a reasonable trade-off, or is the government going to get less value from that sale? That, you know what I mean? Like, so if they're doing it at a discounted price, that could be a problem. So that's something that I'm looking at with respect to Swiss-based trading companies specifically, but they've been they've flown under the radar for a long time, these trading companies, because they don't have a physical presence in many cases. So it's an interesting area that's been kind of a blind spot for the transparency movement as well. So now there are efforts underway within the extractive sector, within the transparency initiatives, to try and get trading companies also to report what they're paying and receiving for their products, in addition to extractive companies that actually have their own assets. So these are an interesting beast that are less well understood and don't necessarily present the same risks as integrated companies. And it's interesting that there's a movement amongst the big multinational companies that do have mines to actually move more towards a trading model, because it's better, right? While prices were low during the last kind of 5 years when commodity prices fell, the traders were still making a reasonable return because their operating costs are very small compared to companies that have multiple mines that still have all their overheads while prices are low, and so their margins are much smaller, and also have to deal with all the kind of political risk and so forth involved in actually operating mines. So increasingly these big mining companies are starting to set up trading arms as well and to buy and sell product. So it'll be interesting to see how that transforms the sector, I think, over the next 5 to 10 years.
Might change it for the better.
I think so.
Anyway, please join me in thanking Alexandra for excellent